All right. I think we're ready to begin now. Thank you everyone for attending this webinar today. I hope you are all having a good afternoon. My name is Gilbert and I'm from Sylvia's Traders Launch, also known as Forex STL. And in conjunction with Scope Markets, today we are bringing you a webinar about stop losses. So if I could share my screen, and in the course of the presentation, if you have any questions, please put them in the Q&A section. My colleague Sylvia has also left some information in the chat area to do with just some links that you can use that I'll be referencing towards the end of the session. So I think it's all there. All right, so let me just share my screen so that you can see what's there. Okay, let me just set this up quickly. All right, so I think that is clear now. You can be able to see that. All right, so risk management strategies 101. Today we're going to be talking about stop loss orders in trading. Now, I don't know what your thoughts are about stop losses. For those of you who are traders, or maybe you're just getting into trading and you've heard about stop losses, and they're usually two camps. There are those people who are in favor of stop losses, of using stop losses, and there are those ones who are against the use of stop losses. So we're going to tackle both issues in the course of the webinar. And after that, it's now for you to make up your own mind about it, whether you should continue using stop losses, or if you're not using stop losses, whether you can continue not using stop losses, or at least by the end of the webinar, you'll find out how you can be able to manage your risks, even if you choose not to use stop losses. All right, so what are stop loss orders? Now, as you can see in that picture there, you can see a guy who is bungee jumping, and he has a harness. Of course, when you're bungee jumping, you have a harness attached to your feet or your waist that ensures that you do not end up falling all the way to the ground. So it's supposed to prevent you from hitting the ground or from hitting the water or wherever it is that you're bungee jumping from. So a stop loss order is basically that. It's a protection. So it's a risk mitigation tool that a trader uses to limit the losses incurred on a particular trade. So when you're trading, you should have a cutoff point in mind. What if you're not correct about your analysis or your prediction? We cannot predict the market 100% of the time. So you're going to get it wrong at some point. And when you get it wrong, what's that effect going to be on your capital? So one way of preventing so much damage on your capital is by use of a stop loss order. Now, these stop loss orders are specific orders sent to the broker as a request to close the trade at a predetermined price. So you can have a particular price that you're looking at that invalidates the setup. So if we get to that particular price level, maybe you're no longer looking to hold on to the trade, maybe the risk is too much, or it means that the signal that you are using, the analysis that you are using has been invalidated. So by the time you get to that price, you no longer want to continue holding on to that position. So you can send a stop loss order limiting your exposure to a certain price. Stop loss orders generally have a price limit, but can also have a time limit. Right, so it could be that maybe you want to exit at a particular time. Now, the time limits are usually a bit difficult to set when it comes to stop loss orders. In most of the platforms that we have, you might not get a time aspect to it, such that you're looking to automatically exit, whether you're in profit or in loss at a particular time. Maybe you've set that if your orders have not hit the take profit by, let's say, Monday, 4 p.m., then it should close all the trades. Now, with the platforms that we have, MetaTrader platforms, we are not able to put a time limit. However, you can manually close out the trade. You can manually close out the trade when it reaches that time that you had set for yourself as a time limit. So if we haven't reached our profit by this time, you're willing to exit the market. So the ones that we can automatically place in the market have a price limit. However, if we also want a time limit to exit the market at a particular time, if we haven't gotten to the profit level that we wanted, you can close those trades manually. So that means you have that particular time in your mind, and when you get to that time, you close it. So that's a form of a manual stop loss. So manual stops can be used for trading conditions that cannot be fixed to a particular price or time. So for example, this is another case of a manual stop loss. Manual stop loss are also called mental stop losses. So it is something that you are keeping to yourself. So you haven't sent it out as an order, but you're constantly observing the market and waiting for a specific event to take place that will warrant you to initiate a closure of your trades at whatever loss that you've incurred. So for those types of trading situations whereby you cannot exactly tell what price you want to exit at, or you cannot be able to tell the time, roughly the time that you'd want to exit at, then you can use a manual stop loss or a mental stop loss. So situations like that could be, say, for example, a situation like that could be, say, for example, you're waiting for a signal to be given by moving averages. Maybe you had taken a sell trade based off of a moving average crossover, and the only time that you will exit from that trade, whether at a profit or at a loss, is when the moving averages cross over again, giving you the opposite signal. So that means you have to be there waiting for that signal to be given, and then you can exit. So if it's at a loss, you're still holding on to that loss up and until the technical indicators that you're using give you a confirmation of the opposite signal. So if initially they're told you a sell, you wait for the indicators to give you a buy signal. So that means you close out your original sell trade at whatever loss that it would have been making at that time. So a mental stop loss or a manual stop loss can be used in such events. So you're not going to like put it at a particular price, or in some platforms you have stop loss orders that have a particular time limit, that if the market has not reached the stop loss price within a certain time period, then it's automatically going to close out that trade. So if you don't have that price and time limits, then you can just have a mental stop loss. So as you see here, this is as you see here, this is an example of stop losses. So you have one for a buy and one for a sell, and that is just supposed to limit your exposure to the market. In some platforms, you can have multiple stop loss orders at different prices for partial closes. However, this feature is very rare in platforms and not available on the MetaTrader platform. So that is MT4 and MT5, and at Scope Markets, we use the MetaTrader 5. So in this kind of an event where you want to scale out of a trade, so that's called scaling out of a trade. So when you want to scale out of a trade, what you can then do is have a manual stop loss. So know the times or the prices that you're going to close part of your trade. So that means you have to be present in the market at the time when you want to close out those trades. Manual stops can remedy this when you close portions of the trade on demand according to your strategy. A stop loss is meant to limit losses on capital, but it can also be used to limit losses on fluctuating profits. Say you have a trade that's already in profit, but it has not yet gotten to the take profit price, and you're still anticipating that the market can move further from where it is right now. So maybe you're in a trade and it's at a $150 profit, but your take profit level is at $250. So there's still that allowance of about $100 that the market could move, and you're not willing to take the $150 right now because you could still have the potential of making an extra $100. So what you can do is you can also move your stop loss from negative. Maybe when you started out, your stop loss was minus $50, but right now you're already in profits. So you can move that stop loss from minus $50 and then place it at positive $100. So that means it's going to be 50 pips away from where the current market price is, because the current market price is 150 pips, say for example, or $150 away from your starting point. So you can put your stop loss to be at $100, such that if the market does not continue on to $250, the intended take profit, and it decides to go back against you, you're not going to end up losing on that trade. It's going to go back. If it goes down by an extra $50, it's going to close you out at positive $100. So those types of stop losses are the ones we call trailing stops. And it can be an automatic trailing stop, or it can be a manual trailing stop. So you can move it manually, or you can have instruct the broker using the trailing stop orders to move with the market, maybe at a distance of about 50 pips. So you're trailing the market at a distance of 50 pips. So a stop loss is not just for protecting capital, but it's also for protecting profits that you have already made, but they are floating. So you haven't taken them, you haven't taken that trade off the table. All right, so that is what stop losses are. Now let's look at the main classifications of stop losses. So we have mental stop losses, which I just mentioned, and automatic stop losses. So mental stop losses are also called manual stops. Then the second category is automatic stops. They are also known as hard stops. So when most people are talking about stop losses, they're talking about the automatic stops, the hard stops, the ones that you send as an order to the broker. So when people are talking about, whether you use a stop loss or you don't use a stop loss, most people are referring to these automatic stops. However, it is good for us to also look at mental stops, because this is still a risk management aspect. It's only that it's a bit trickier to have mental stops, because you have to be physically present when executing them, as opposed to the automatic stops, which are sent out as an automatic order. And from there, you can be, you can be anywhere. You can even be in the swimming pool, or you can be in bed at night, and that stop loss is going to be executed on your behalf. But a mental stop loss or a manual stop loss, you have to be present. So a mental stop loss is where the trader manually closes out a trade at a loss when he or she determines the trade setup to no longer be viable. Like I was saying, for those types of strategies whereby you have to wait and see whether or not you are correct about the trade, and you're waiting for a specific trigger in the market that will then give you that confirmation that you need to exit from that losing trade. Now, the determining factor can vary depending on the trader. It can be arbitrary based on feelings, or it can be strategy based, or it can be strategy oriented based on an opposing signal. So there are some traders who say, I'll know when to exit when I get a feel of the market. So you wait for the market to go. When you feel as though, yeah, you're completely wrong, you got it completely wrong on that trade, then that's the time you can exit. Or it can be strategy based, like I was saying about the moving average crossovers. You're waiting for a particular trigger in order for you to exit. All right, so I can see a question coming in from Daniel. Maybe what you can do is you can type it in the Q&A section, so that when I'm through with the presentation, I can be able to address your question. So kindly just type them in the Q&A area. In case you can't hear me, let me know. Just type it in the Q&A or the chat area in case I'm not audible, and I'll be able to adjust my settings. All right, so that is George. So what I'll do, I'll answer your questions towards the end of the presentation, but keep typing them in. And also let me know whether you're in favor of using a stop loss or you're against using stop losses, and what your reasons are, right? If you use stop losses, why do you use stop losses? If you don't use stop losses, why don't you use a stop loss? So give me your thoughts in the Q&A area or in the chat area. All right, so these mental stop losses are used more efficiently by professional traders. And this is because as a pro trader, you've been in the market long enough for you to know that if you're wrong about a trade, you need to exit. So you're in better control of your emotions than, let's say, traders who are new to the game. So new traders will struggle implementing this accordingly. I know that because when I started out, I had a problem following through with my stop losses. I kept on taking them out, right? And that is even automatic stops I had a challenge with. But at least with an automatic stop, before I move it, further into losses, because I do not want to close out at that loss. So I'm still thinking I could be right. At least with that one, I would second guess myself a lot. You'd end up looking like a fool later when you eventually get knocked out at a bigger loss. But a mental stop loss, as a new trader, you can give all sorts of excuses to yourself to prevent you from executing or closing out that loss according to your strategy. So you do end up struggling as a new trader with mental stop losses, but it becomes easier for you to have a mental stop loss once you've been in the game for a considerable period of time, whereby you've been able to assess the times when you failed to execute the stop loss, what happened. So you're able to get like a good audit of yourself. All those situations where you decided not to execute the stop loss, what the outcome was, and you can be able to go through all those different outcomes and come to a rational conclusion that you're supposed to execute that stop loss when your strategy determines, or when your rules determine you're supposed to close it out. They're mostly used in strategies that involve an extra confirmation. So for example, maybe you wait for a candle to close maybe below or above a moving average, or you're waiting for a candle close above or below a support and resistance. So you don't just exit based on a price, you have to wait for the candle to actually close. So in such situations, you may end up you're more likely to have a mental stop loss, including even this one's for moving average crossovers, or it also could be like if you're using RSI or stochastic, so you're waiting for an overbought or oversold condition, then that's the time you can exit the trade. So in such situations, yes, you're going to end up having a mental stop loss. It's going to be difficult to put an automatic stop or a hard stop on that kind of a strategy. Now, the challenge with mental stop loss is that it requires your presence on the screen to close the trade. So if this condition is met at a time when you're not present in the market, you could even just be slightly distracted by something that you're doing. A lot of people trade actually, and during office hours. So you're busy doing your job, especially if you have a desk job. So you're busy on your computer doing your job, and you have your platform somewhere there in your laptop or on your phone or on your tablet. And you could easily get distracted and you miss out on that precise time and price that you're supposed to exit. So that is the challenge of mental stop losses, is that it warrants your time, your presence, in order for you to execute it. So what about automatic stops or hard stops? So these ones are easier to implement because it's just an order that you send to the broker. However, you must have a price in mind, right? Because they are price-based stop losses. Other platforms may have a time-based stop loss, but for MT4, as per my last check, unless the new updates have changed, we only have a price-based stop loss. So what you do is you key in the stop loss price, and then you send it over to the broker. So let's see if maybe I can just give an example of this. So let's say I'm on my MetaTrader here, and I see as if the market is going to break. Let's say it looks like it's going to break this stop loss over here, this support level here. So let's say I make an order and I decide, you know what, let's do 0.1 and I sell. So I've made that trade there. I'm expecting that the market is going to proceed further down, but then I could be wrong about this. Okay, so I could be wrong about this trade. So instead of me waiting, hanging around, waiting to see what ends up happening, I could decide, you know what, if this market decides it's not going to go down, then I'm only willing to limit my risk to this price. So I'm only willing to lose, let's say, about 190 pips there which would be, if you can look at the left side of the screen, it's about $18 or so. So I'm only willing to lose about $18. So I've just automatically or just sent this order to the broker just like that. And you can see it's marked as sell. So that is a stop loss. And that means throughout the remainder of the webinar, I can continue with my webinar without needing to keep on checking on what's going on in the market, because I have already issued my instruction that in case things go wrong and the market decides to go back up and knock me out, this is as much as I can lose, about 18 or so dollars. So that's your automatic stop or your hard stop. Okay, let's go back. Just a second. All right. So a trader can change the price in the course of the trade to adjust the exposure. So say we continue going into profit, I can decide to move this from minus $18 was where it is right now, where I've originally set it at. But if we continue going into profit, I can decide I no longer want to have any negative exposure on that trade. So I can end up moving it beyond my entry point or below my entry point because it's a sell. And that will ensure that if we do not continue further into profits, at least I will get taken out at a small profit. So at that point, once we've already seen a considerable profit, I can decide I no longer want any loss exposure on this trade, and I can move the trade beyond break even or beyond the entry price, thereby limiting exposure to only a loss of a profit, but not a loss of your capital. Automatic stops do not require your presence when closing the trade. It's executed automatically, and that's why if things go wrong, we'll be able to find out later because it's going to be closed automatically. And most of the arguments against using stop losses tend to be in reference to automatic stops. So when people are saying they don't trade with a stop loss, it's not that they don't close out losing trades. You will eventually close out a trade once it gets to a loss that you're no longer comfortable with. But most people who are saying they don't use stop losses, that they are talking in reference to automatic stops. So at some point, you will have to close out a losing trade. And it's based off of your own analysis. Most of the people who don't use stops, professional traders who don't use stop losses, they usually wait for a specific event to occur as a confirmation that they were wrong about it. But you could also have other traders who have a policy of, I am correct, I'll eventually be correct. If I wait long enough, the market will eventually go in my favor. And those are the dangerous types of situations, or the dangerous type of reasoning whereby you say that I can wait it out long enough for it to come back to the profit, back to a profit. And that is because it's not based off of any analysis. You could actually be ignoring analysis that is saying that you are wrong, but because you have a policy of I don't close losses, I'll eventually wait for it to come back into a profit, could end up holding on to profits for a very long time. And we'll look at a strategy where you end up holding on to losses for quite some time before you close them out, just so that you can see that there are people who actually do this type of trading. Hopefully it's based on an actual analysis. They're not just holding on to those trades just for the sake. So those are the two classifications of stop losses: automatic and mental stop losses, or manual stop losses. Now from there, we want to look at the types of stop losses, right? You can either have them as mental stops or as automatic stops, but there are different types of these stop losses. So the first type of these stop losses is the trailing stops, right? So what is a trailing stop? A trailing stop is a stop loss that trails the market price with a predefined number of pips. So it's trailing the market at a particular pace. So if you've watched movies about, investigators, cops and robbers, how maybe the detective will be trailing a suspect and they have to keep a particular distance to ensure that they're not detected. So a trailing stop is kind of like that. You're keeping a certain distance from the market to allow the market to move about without it coming to knock you out prematurely. You can have this as both an automatic stop, trailing stop, or you can have it as a manual trailing stop. Now, it's used to hedge the risk of the trade not getting to its intended profit price, especially for those strategies where you have a high risk to reward ratio. Maybe your stop loss is $20, but your take profit is, let's say, something like about $120, right? So your profit is 6 times your loss, right? So there are times the market will not get to that $120. It might just get to $60, $70, then it turns. So if you don't have a trailing stop in such situations, you could have actually seen a $60, $70 profit, and then you end up walking out with a $20 loss because the market did not reach your take profit. So in that case, you can trail it. Maybe say, I'm going to trail it with a distance of $30. So as you make your first entry, when the market goes $30 in your favor, then the stop loss moves from minus 20. It goes to 0, break even, so that it's $30 away from the current market. When the market goes to $60, then your trailing stop moves from 0, that was break even, to positive $30. And it carries on like that up and until the market decides to turn against you, and it's going to knock out your stop loss at whatever profit it had been able to secure by that time. Now, trailing stops are also used to quickly secure any small gains that are made and limit the risk of a loss at a future date. So this is where you have trading psychology come in, when you're trying to balance out greed and fear. Usually when you make a profit, you're a bit hesitant, maybe I should take this profit before things go wrong and I get knocked out, I go back into a loss. So to be able to balance that out, you can decide, okay, let me do this. What I'm fearful of is the market going back into a loss, but I still need to hold on to this trade long enough to see as much profit as I can. Because again, I don't want to be closing small profits, and then when I hit a loss, my losses are bigger than my profits, because it means that I'll be going 1 step forward, 2 steps back. So a way of being able to ease your mind in such a scenario where you really want to close out that profit trade, you can have a trailing stop, such that at the back of your mind, worst case scenario, now that we've moved the stop loss to positive 30 and the market is at positive $60, I would want to close at $60, but I could potentially miss out on making $120 if I do so. But again, the market may not even get to that $120, and I could lose the 60 that I have right now. You know what they say, that a bird in hand is better than a couple of them in the trees. I can't remember what that saying used to be, but something like that. A bird in hand is better than a couple of them in the bush. So you're trying to kind of balance out that fear. So what you can do is that by having that trailing stop, worst case scenario, I still walk out with $30. $30 is still good. So worst case, I walk out with $30. Best case scenario, I walk out with $120. Either way, I'm going to make money. So in such a case, you can actually allow that trade and give it enough room to move so that you can see how much you can take from the market. The next type of a stop loss, so that's the trailing stop. So the next type of a stop loss is an equity stop. An equity stop is a stop loss that is based on a percentage of your account equity. Now, this is the most ideal risk management tool for limiting losses, especially when your strategy has discretionary exit rules for losses. Now, an equity stop is the most ideal stop loss. And the reason for this is because it's based on a percentage of your equity. So you could say that, say, for example, that account that we made that trade, it's about $10,000. So I could say that I have allowed, I can allow a trade to move against me by not more than 2%. So I can give it an allowance of 2%. But the moment I lose 2% of my equity, I no longer want to hold on to that trade. So 2% of $10,000 is about $200. So I can allow a loss to fluctuate within a $200 range. But the moment I get to that $200, I no longer want to hold on to that trade. Now that $200 could be in pip terms, 200 pips. It could be 2,000 pips. It could be 20 pips, depending on the lot sizes that you're taking. But what that means is that depending on, or regardless of your strategy, you can allow the market to move within that range. And the moment it exceeds that range or it gets to the edge of that range, you close it out. So this one tends to be much easier to implement than the other types of stop losses where it's easy for you to second guess, because if you said that you cannot lose more than 2% and you decided I will not lose more than 2% on any trade, then you have to execute it based off of that risk management principle that you've set for yourself. So most professional traders trade using equity stops, and they can merge an equity stop with other stop losses, but the equity stop is the overall cutoff trigger. So if we get to that level, regardless of what you thought, regardless of what the market is saying, regardless of anything, you close out that stop. And this is good for people who say that they don't want to trade using a stop loss. You know, there is no trade that is the same. Each trade is different. So for those kinds of traders who do not want to trade with stop losses, then you have to have some form of a risk management tool that is going to limit the losses that you can handle or that you can take or incur in any given trade. And an equity stop is the best for traders who don't want to trade using a stop loss, even if it's a mental stop loss that is based on maybe analysis or whatever. But if it's based off of risk management principles, then that is much easier to execute. We also have margin stops. Now, margin stops are also used by high-risk traders. These are the kinds of stop losses that are used by high-risk traders. These are traders who either trade without any stop losses, trade be damned, or capital be damned. They don't want to close out any losses. They're willing to take the risk, and they're willing to mortgage the entire capital on every single trade. So for those kinds of traders, then you can have a margin stop. So a margin stop would close you out around the same price as the broker would during a margin call. So a margin stop is like a margin call that you as a trader have initiated yourself. So you've put it at, by the time or roughly around when I'll be getting a margin call is when my capital will have fallen to this level. So let's say when I lose 90% of my capital, that's the time the broker will instigate the margin call. So the price level where I would have been losing, or I'm likely to be losing 90% of my capital, that's where I'm going to put the stop loss to allow your trade to move about. And like I said, this is a very dangerous type of a stop loss to have. It's basically like trading. It's not even basically, it is trading without a stop loss, without any stop loss, no mental stop loss. It's not really even an equity stop loss. It's just basically a margin call, right? You'd rather, it's kind of like you want to be the one in control of your own margin call. Instead of the broker being the one to close you out, you decide, I'm going to close myself out before you do that. So it's almost like the way someone can decide to quit when they know they're just about to be fired by their bosses. So you're going in that morning knowing I'm going to be fired, but what I'm going to do is I'm going to go, and before he speaks, I'm going to say, I quit. So that's the equivalent of a margin stop. It's a very dangerous type of a stop loss. Technical stops. Now, these are the ones that are used by most traders. It is a stop loss that is based on technical patterns. So it could be a support or resistance level that if the market exceeds that support or resistance level, you'll be looking to close out the trade. It could be based on technical indicators like crossovers, moving average crossovers, maybe oscillators like RSI and stochastics. Could be based on any type of tools. It could even be based on, say, things like ATR, average true range. So you're looking at volatility. So if maybe a pair usually ranges, let's say Euro USD usually ranges within a 70 pip range. It usually moves within a 70 pip range. So you could put your stop loss maybe 2 times of ATR based off of the last 10 days. What is the average daily range that the market would move on that pair? So if it's about 70 pips, then you say maybe I'll put my stop loss 2 times of the ADR or ATR. So that's going to be at about 140 pips. So it could be a technical based stop loss like that. This is the most common way to determine a stop loss level. And this type of stops, technical stops, they're the ones that are best used with these other stop losses, like the equity stop. So you could have a technical stop that is also being merged with an equity stop. So for example, if your technical stop is violated for whatever reason, maybe you don't have a clear, you're not quite sure whether that trade setup has been invalidated. So you're still 50-50. Should I close it? Should I not? So if maybe you violated a technical stop, at least the equity stop is going to remain true. So as much as I'm uncertain about whether I should close that trade, when we get to the equity stop loss cutoff, right, that percentage of capital that I should not lose more, I should not lose anything beyond that percentage of my capital, then you're going to close out the trade regardless of anything. You're supposed to close it out. They say that you're supposed to close out that stop loss. This is some jokes by traders. Even if it's Armageddon, even if people have been raptured and it's now the end of the world, so that means you don't really even need to do anything. Even if the trumpets have been sounded, you're still supposed to close that trade at that percentage that you had determined. So you're supposed to follow it religiously. All right, so that's to do with the types of stop losses. Now, let's look at the cases in favor of using a stop loss and against using a stop loss. So let's begin with the first one. Now, this is a meme that I've gotten online. So this is traders who don't use stop losses. So as you can see that caption there, oh, you don't use any money management in your Forex trading. I too like to live dangerously. So it's a bit cynical, right? Someone saying, I like to live on the edge of things. And that's why I don't use stop losses, be they mental stop losses or automatic stop losses. Now, what are the arguments in favor of trading without stop losses? So some of the arguments are, the market hunts stop losses. Each time I place a stop loss, I get knocked out, then the market eventually goes in my favor. So this is because stop losses tend to cluster around known levels, because most people are using support and resistance prices in order for them to place their stop losses. So it's very easy for market makers to move the markets towards those clusters. And it's not that they really want to eat your money. It's because they're looking for commission. So they move the market to where the most business is. And since stop losses tend to be closer to the current market price than take profits, that's why you see the market moving to your stop losses first before it moves to the take profit, because you're all thinking the same thing. We're all thinking the same thing in terms of where we would want to cut it off, right? We are trading smaller time frames. We are using support and resistance, very clear areas where we would want to place a stop loss. A lot of us are doing the same thing. So those stop losses end up clustering around the same area. And, that now attracts the price. It attracts the price from the market makers' algorithms to move the price or to move the market towards your stop losses. It is more profitable to let trades run, especially when trend trading. So this is another argument that so long as you're trading within the trend, you can allow for those retracements. That time the market may pull back, it may overextend its retracement or its pullback, knocking out stop losses, and then eventually it reverts back to the main trend. Now, this is true. There are those times where the market does overstretch and knockout stops, and then it eventually goes back to the trend. However, there are times, and you may get this right, 200, 300 trades, you can get it right. But there's one time that you will get in at distribution phase at the end of the trend, and that trade will not come back into a profit anytime soon. So there is going to be that one time when you get the trend wrong and the market just goes against you and continues going against you even for a year. I have held on to a trade based off of this aspect. This was some years back. I was doing a strategy called gap trading, where the market always closes the gap, right? You can get, even 100 trades correct, but there's going to be one trade where the market decides it's not going to go back to that Friday's closing price. It's not going to close the gap anytime soon. And it went against me for an entire year. So you're holding on to a trade for more than 12 months. You can imagine how my dreams were. My dreams used to have candlesticks, because I'm just dreaming of how I'm going to get rid of that trade at some point so it can stop causing me stress. So yes, you will get it right very many times, but there's that one time you'll get it wrong, and that will potentially wipe out all the profits that you've made. Another argument, probability of the market going extremely against you is very low, especially if you're using small lots and you're targeting small profits. True, if you have small lots, you can actually hold on to a trade long enough. But remember, there's something else called swap, right? The rollover interest, the cost of rolling over a trade. And those swaps can add up. And they can increase, especially if it's negative swap, it can go and increase your loss, the size of your loss, right? So now you'll be holding on to two losses. There's a rollover loss, so you have negative rollover interest, and you have negative pips. The market has gone against you. So there is that one time. And because the probabilities are not 100%, so long as there's a small margin of error, could even be 1%. I've seen accounts blow up that had a 99% success rate. Did even 700 trades in a row, profit. Then 2 trades wipe out the entire gains that you have made, including a sizable part of the capital. So you cannot have probabilities, use probabilities without risk management. Probabilities have to also go together with risk management, because trading is not just a game of predictions. You're not just predicting where the market is going to go. It's actually a game of risk management. And if you've ever played Monopoly, you'll realize that it's not the person who gets the prime real estate on the board who ends up winning. It's the guy who is managing their funds, right? Which means they're very, they land on a particular plot. It may not be a high value area, but they buy it. It's all about just buying those plots when you get them. It may not be the ideal, but you're just buying. So it's a game of risk management. It's a game of tact. It's a game of longevity. But it's not entirely a game of probabilities, of predictions. Because there are times where you predict things wrong completely, and you can't recover from that because you didn't adhere to strict risk management principles. So there are other ways to manage risks other than using stop losses. It's true. You can use correlations to hedge out the risk. For example, if you're trading a pair that has the dollar, let's say euro dollar, and you've gone long on euro dollar, that means you've sold the dollar and bought the euro. Then as a way of reducing your exposure to the US dollar, because you've sold it, what if the dollar gains in value? Your buy trade on euro USD will make a loss. So you could go to maybe another pair that has some positive correlation to euro dollar. So maybe that could be, say, euro versus the Japanese yen. You could also have maybe euro pound actually tends to have a good correlation to euro USD. Another one that has a good correlation, though it's negative correlation, is USD versus the Swiss franc. So what you could do is in one pair, you're selling the dollar, but then in another pair, you decide, okay, I'm not going to sell the dollar even in this pair. What I'm going to do is I'm going to buy the dollar. I'm going to look for an analysis that validates me buying the US dollar. So in that case, at least you've hedged out your exposure. If one trade makes a loss, the other one is going to make a profit. And, so long as that correlation continues, then that is going to act as a hedge. There are times when these correlations break. Twice in the last 15 years, is it almost 15 years? It's 15, no, it's about, almost 15 years. No, less than 15 years, about 13 years. Correlation between euro dollar and dollar Swiss has broken, like horribly broken. And those are pairs that have above 95% negative correlation, which means they go in opposite directions 95 and above % of the time. So it's a very good negative correlation. You can hedge out with those two pairs, but there are times they started going in the same direction. That was 2008. I remember that one. And 2015. I think people who've been trading for the past 6-7 years know what happened in 2015 with the Swiss franc, where there was a major announcement by the Swiss National Bank that caused the Swiss franc to gain aggressively in value, and it broke that correlation. So you never know, when that correlation is going to break, and also the times when it broke out extremely. But on an annual basis, there are those days or weeks where that correlation breaks. It ceases to be near perfect. It can even have no correlation for a few days or even a few weeks. During that period, your losses can widen, just the same way your profits can widen in case things were going in your favor. So yes, hedges using correlations are a way of managing risks without using stop losses, but those correlations do break apart. Nobody wants to be wrong about a trade. Losing sucks. I think this is a true argument for everyone. Nobody likes to lose, right? I don't think there's anyone who loses and smiles, unless, you're one of those guys who'd be in Arkham Asylum, then maybe you'd smile and be happy when you lose, but nobody likes losses, right? So this is an argument that people use. It's not good for my mind. It's not good for my mental state for me to be closing losses all the time. So I'll just hold on to these trades up and until they go into a profit. That's a very bad way of going about things. Strategies that have a high profit potential tend to have small profit targets with wide stop losses or none at all. So the people who are in favor of not using stop losses most likely have scalping strategies where they're targeting very few pips. Could be just under 5 pips. You're in and out. So the market will almost always go in your favor. And it can even go in your favor. Like, for the market to move at least 2 pips in your favor, that is going to be an almost always occurrence. This can even happen for 700 trades, but there's going to be that 1 or 2 trades that will basically disrupt your entire capital. So for those particular kinds of strategies, you will find that you hold on to losses for quite some time, even if you're just closing small profits. So it looks your count is growing, but if you look at your floating loss, your floating positions, you're holding on to very big losses. And we said that swap rates, especially if you have negative swap, that could also increase your losses or the exposure that you have in terms of losses. All right, so what about those who are in favor of using stop losses? So here's another meme that shows Dwayne "The Rock" Johnson. This is a movie. So he's asking his passenger, you placed a stop loss, right? The passenger is responding, what is a stop loss? Alama ya mshangao. So he's right there just shocked. What do you mean you're not using a stop loss? So those in favor of using stop losses, these are the arguments. Better to be safe than sorry. I would rather close a few small losses than to deal with a big loss on my account. you can always recover the loss on the next trade. This statement rings true for me that time when I held on to a losing trade for about a year before I eventually closed it at a profit. Now, thankfully for me, I was having positive swap. So actually, it's the positive swap that allowed me, that had gained considerably, that allowed me to eventually do away with the trade, even if I had a negative PIP. I had a PIP loss, but the swap was greater than the loss at that time. So I was able to eventually close it at a net profit. But that was the last time that I traded without having a cutoff level. So you can always recover. So I kept on, even in my dreams, I kept on dreaming of me just closing the trade and getting on with life. So you can always recover that loss. It's never that serious. It's a small loss, or maybe even 1%. You can recover that on the next trade. And that can be a distant memory. I don't think any of you remember the losses that you've made on Monday, if they were small losses. You've just been chewing losses in the course of the week and you're still at a net profit because you close out losses and profits along the way. I don't think there is embedded in your mind that one particular loss that you made, or you remember all the losses that you've made on Monday, trading Monday, or even last week. Maybe Monday is too close. Let's say 2 weeks ago. Do you even remember that loss that was causing you so much pain? Because you moved on, right? So you can always move on. Just learn to let go of bad trades. A trader cannot be right all the time. You'll have to get it wrong at some point. So this is someone who's pragmatic, someone who lives in a realistic world. Can't be right all the time, right? You can't get things right all the time. There's going to be that time when you get it wrong. So you need to give yourself an allowance for mistakes. How can you still recover from a mistake? If you make a mistake that you can't recover from, why put yourself in that position? Deal with mistakes swiftly and move on with your trading. If you've made a mistake or if you're wrong, accept it, move on. This is now that kind of trading that is professional trading, where you're devoid, or at least you're in control of your emotions. Fine, you're wrong, you really thought you were correct. Always have a plan B. For me, I always have a plan B. I look at every trade skeptically. Even if I've done all my analysis, I'm always skeptical about the result of the trade. And that allows me to move on almost instantly when I make a mistake, because I'm like, yeah, kind of thought so, it wouldn't eventually go. And when it goes into a profit, be like, oh, okay, cool, went into a profit. So I've learned of ways to deal with losses, and you can also learn how to deal with losses. For people who use high risk to reward ratios, it means that you will eventually, you don't have a good probability of success. You'll find maybe your probability of success is around 60 to 70%. So 60 to 70% of the time you get it right. You might even be getting it wrong more times than you get it right, but because you have a high risk to reward ratio, you can close out those small losses, because you know that when you make a profit, that profit is 5 times, 6 times the size of your loss. So even when you hit 3, 4, 5 losses in a row, and then you hit 2 profits in a row, you've even forgotten about those losses because there wasn't even much of a dent on your capital. All right, so just remember this meme. You can also go look for it online. All right, so why do most traders lose their money? I hope we have enough time. Oops, we are almost out of time. So let me be a bit swift with this. So why do most traders lose their money? So according to Olimtrade, this is a binary options broker. I think they do binary options. Around 90% of all traders lose money on that Olimtrade on their platform. This is only leaving 10% who are making money. Now, of course, this is not just in binary options, also in FX, also in stocks, just basically trading in the financial markets. There's a high losing percentage. And why is it that most traders are losing? So of course, this 90% were not planning on losing their funds. They may have even been winning trades. They have been making profitable trades, but in the end, profit is too small to cover a huge loss, right? This also just goes to show you, that kind of trading where people don't really have that ability to close out losses early. just want to wait for the market to move back in your favor. We can successfully put men on the moon. We can perform open heart surgery. We can even map the human genome. So why is it so hard to stay on the right side of financial markets? True, can do all these things. You'd have even gotten an A. Some of you here are A students, right? You got A in KCSE. You graduated with honors from university. So why is it when you come to Forex, ni kutandikwa tu? Napigwa tu fimbo in this, napigwa tu mabare in this market. So why is that? Why is it that it's so hard to make money? So the simple answer is emotions. It is the number one enemy of successful trading. We tend to make emotional decisions most of the time, especially in a high pressure environment such as the financial markets. So emotions lead to an imbalance of fear and greed. So you need to have a proper balance between fear and greed. Fearful enough for you not to make reckless decisions, and greedy enough for you to get going. When you make a loss, move on, make a new trade, try and recover from that loss. So emotions tend to lead to an imbalance of this greed and fear. And this has an influence on our profits and losses. The fear of losing your money, right? So that is where, when you have an imbalance, maybe you're too fearful of losing your money, so you just go closing very small profits. And also the greed of making instant riches. Maybe you believe you can, become a millionaire overnight, and you're really dependent on that belief to work out. So you will make huge trades, and you will not close them out at losses. You will wait up and until they go back into profit. So risk management is the key. So successful trading involves objective decisions regarding your risk and reward. So rational decision making will put you in the 10 percenters. So it'll put you into these 10 percenters who make money. So that's because they make rational decisions whilst in the midst of an irrational market, because the markets are driven by irrational behavior. And 90%, they're being driven by these 90% of people. Mind you, even trading institutions make irrational decisions. Remember the great financial crisis of 2008. It wasn't retail traders, you and I, who caused a crisis. It was banks and hedge fund traders and all these institutions that we believe always make money. The house that always makes money doesn't always make money, right? It does get to a point where they also engage in irrational behavior and they bring the entire house down. So it's all about remaining rational, sticking to your principles of trading, sticking to your rules, even when there's a lot of hullabaloo around. You need to stick to your rules. Warren Buffett, till this day, still does not want to invest in crypto. Even if they may decide to put a little bit into it, he's very skeptical about it. And that's because according to his rules of investing, crypto does not match his investment criteria. So even when he's questioned during the AGM meeting, AGM, or during the meeting, yeah, I think it's like an AGM of investors, and they're asking, why didn't you invest in crypto? Bitcoin has done all this percent, all this, all that. And they'll say, the fundamentals behind it does not match how he invests, right? It doesn't match his criteria for a long-term investment for him. So you need to remain rational. If these are your rules, regardless of whether they're right or wrong, so long as they're rules and they make you money in the long run, stick to it. Stick to what makes you money. All right, so how do we mitigate risks when trading? So how do we prevent ourselves from, crashing down, getting a margin call? So have clearly defined exit plans. So the hallmark of successful trading is in the efficacy of your exit strategy. It is more to do with how you finish the race than how you started it. You could start out, with a profitable trade. It looks like it's going into profits. And then before you know it, you exit with a very big loss because you've mismanaged it. Or it could even be your equity. You start out making really good trades. Your capital grows 20%, 40%, 100%, 150%. And then, the reckless decisions of the bad risk management rules that you follow, or maybe you don't even have any risk management rules, it catches up to you, right? So when you're flaunting risk management principles, that eventually catches up to you, and you end up losing more than you had even gained during that entire period. So have clearly defined exit plans. Even if you're not using a hard stop, right? That stop loss that you send to the broker, have a clearly defined exit. At what point are you going to cut off the trade? At what point are you going to cut it off? You already have a point you're going to cut it off, or criteria to take the trade when it's at a profit. So why not also have criteria to take out the trade when it makes a loss? So have an exit plan. Have a maximum equity allowance for each trade. This is the best. This is the best way to regulate. This is how our parents regulated us during our teenage days, by giving us a specific allowance. Remember in high school when you used to get that allowance, or what it used to be called, I think it was just called allowance or pocket money. And that was a way of our parents regulating the amount of damage that we could do to ourselves using that money. So if it was fixed to a certain amount, they knew this, you're mostly just going to use it to buy mandazis and stuff in the course of your school term, and maybe pay for going for functions here and there. Definitely, you're not going to spend 500 on drugs, right? But if you've been given pocket money of 20,000 every term, you're going to look for ways to spend it. And human beings and ideas, you can always get bad ideas on how to spend money that you have more than you can think of decent ways of using it. So regulate yourself as well. So have a maximum equity allowance for each trader, so that you can ensure that it does not, your account does not get damaged by the extremities of your decision making. All right, hedge out your trades using correlations. This is for people who don't trade using stop losses. At least ensure that if you're making multiple trades and they all don't have stop losses, and you don't have any intention of closing them at a loss, then at least hedge them out by not doing the same thing over a period of trades, over a series of trades. Maybe you're long Euro USD, then you go to Pound USD, you're long Pound USD, then you go to USD Yen, you're short USD Yen, then you go to USD CAD, you're short USD CAD. You're doing the same thing, you're just selling the dollar across the board. So if the dollar gains, all those trades go into loss. So that's going to have many drawdowns, or the size of the drawdown on your account is going to reach a level that is not manageable. So at least try and mix and match if you're not going to use stop losses. I still advocate for you to have a stop loss, especially an equity stop loss, right? And an equity stop loss can also be a mental stop loss, but have a criteria to close out your trades. Avoid averaging down strategies when trading without stop losses in Forex. Averaging down strategies are those ones where you add on to the trades, or adding on to losing trades when you're trying to find the turning point. Maybe you've gotten the turning point wrong and you're just adding more trades, thinking that you're getting them at a discount, but none of them have stop losses. The market could just invalidate whatever it is that you're doing and continue going against you. Use minimal leverage when trading with wide stop losses, or even without any stop losses. Try as much as possible to lower your leverage as much as possible, so that by the time you come to your senses, at least about having a cutoff criteria, at least your capital will still be surviving. You'll be able to walk out with something by the time you come to your senses. Success in trading is linked directly to good risk management. So manage your losses for greater profitability. All right, so that marks the end of my presentation. Sorry, I wasn't able to show you some strategies that, strategies that maybe are done using a stop loss, what's going on, and these other ones. But in my future webinars, especially the webinars where I'll be talking about signals, that's going to be Q3. So within the next 3 months, so that's June, July, August. In one of those months, I will be having a webinar where I'll be talking about signals. So we'll get to look at live accounts that are not using stop losses, what's going on in that kind of an account, accounts that are using stop losses, but their mental stop losses, they're quite wide. What also happens in that account, an account where the stop losses are smaller, the losses are smaller than the profits, how is that account behaving like, and what does that mean for your equity? So we'll be looking at that in another webinar. But for now, thank you. I will now look at the Q&As. So let's go to the Q&A section. All right. So maybe I can stop the share so that you can get to the Q&A. So George is saying, is it possible to close part of the trade as it's running and let the rest of the trade run? Yes, this is now when you're using a manual stop loss, you can do that. You can close part of the trade. So for example, this trade, hopefully, let me just share again my screen. Hopefully if it hasn't been closed out. So as you can see, this is the trade that we had made earlier on. Now let me even give you a practical example of a manual trailing stop. So I can move this stop loss. Remember, this is where it was, minus almost $20. I can move it to be a stop loss to prevent me from losing all the profits that I have. So they have moved it. So now it means worst case scenario, I'll walk out with $8. If the market does not continue going in my favor, I can walk out with $8 at the worst case scenario, but this trade no longer poses a risk. And I can even decide to close part of the trade. Remember, this is volume 0.1. So I can come to this section for closing it. I hope it doesn't close all of it, all right? So when it gives you this pop-up box, you can decide to key in the amount up here. Normally it comes in with the full amount, the full trade, for you to close out the full trade. So you can come and type in the amount you want to close. So I want to close half of 0.1, which is 0.05, close there. So we booked a profit. It's right here in history. There it is. We booked $10. So we are now left with another $10. And this $10, worst case scenario, I can walk out with $4 from this 10. So in case the market does not move back, continue moving in my favor and it comes back against me, I'll still walk out with 4. So worst case scenario, I walk out with $14 from this trade. Out of the $21, $22 that was there, worst case scenario, I can walk out with 14. Best case scenario, the market continues to fall, right? So best case scenario, the market continues to fall and we even get to a take profit point. So maybe I can even create a take profit right there. So that's my take profit. Best case scenario, our $10 plus $20, we can walk out with $30. Worst case scenario, market goes back against me. I walk out with $4 plus the 10 that I closed, I walked out with 14. So either way, it's profits. And that's a good way of risk management, or at least of managing transactions. So that's how you close part of a trade. Does Scope Market offer trailing stop loss order? Yes, it's there. In the current stop loss, you can add a trailing stop to it. So when you right click on that trailing stop, or even when you just right click on your order here, you can go to trailing stop and you can set one based off of this arbitrary points, or you can do a custom one. So you can say maybe for a custom one, it's going to trail the market maybe by, let's say, 200 points or something like that. So each time it moves, it can keep that buffer of 200. And remember, it never goes against you. It only moves in your favor, but if the market starts moving against you, it's going to lock the current price or the last price that it had moved in your favor. So at least you're able to book profits along the way. All right, with another question. What criteria can, this is Calvin, what criteria can one use to set stop losses other than risk reward ratio? I think I already mentioned that. You can have, it could be signals, maybe crossovers of moving averages. It could also be maybe support and resistance levels. So it's not always a risk to reward ratio that determines. Most times people use support and resistance levels to determine exit points, either for a stop loss or for a take profit. If you look at how I've determined this take profit is because of this former support. So if the market gets to this area, it's likely to bounce off of it. So I'd want to exit from that trade. How can one put the equity stop loss? Now, this one is an interesting one because there's a calculation to it. Now, unfortunately, I'm not going to be able to go through it due to time. But maybe what you can do, Willie, let me, in the comment section, in the chat section, let me put my email address. Reach out to me because of time. Let me put this, my email address. So my name is Gilbert. This is my email. Email is at gmail.com. So kimarigilbert@gmail.com. So you can mark that email and just send me your questions there so that I can be able to explain. So I'm just going to go through the ones that need a fast explanation due to time. Again, Robert, reach out to me. I'll give you a more detailed explanation of how you can set an equity stop loss. Trailing stop, we've already talked about that, Alex. So for equity stop loss, reach out to me for that. Of the 3 stop losses, trailing, equity, and technical, which one is best for a beginner who has a small account like $30? The best type of a stop loss is always going to be an equity. So you should have an equity stop loss as part of your risk management. Then from there, you can determine your exit criteria, because a stop loss is just based on your exit criteria. So you have to look at your strategy. You know, when is your signals, or when are your signals invalidated? So when you get an opposing signal, then that means you should be exiting from the previous signal. Placing stop losses with gold with small accounts of $200. Just make sure you trade small lot sizes, Esther, and you can always place regarding or depending on your strategy, whether you're using a price action strategy, whether you're using indicators. I do advise for mental stop losses for those types of strategies where you cannot fix a particular price, right? But mental stop loss, you have to follow through. That's the catch. So if you know you're not good at following through with your stop losses, then it's best to start out with automatic stop losses. So as a beginner, start out with automatic stop losses. Once you feel as though the automatic stop losses are not working out well for you, then you can do mental stop losses. But remember, you have to follow through. And again, for you to switch from automatic to manual stop losses, there has to be a reason. Is it that you get stop hunted most of the time? It means you're putting your stop losses too close around where most people would put the stop losses. So you need to analyze the past trades. How far did the market go against you before it went into profit? Or at what point, what support, if you're using support and resistance, what support levels did the market not surpass, right? So are you supposed to use not the most recent, but the second most recent stop support or resistance? So you also need to, to analyze your trades to find out why you are getting knocked out too early, yet you are correct about the trade. All right, so I'd advise, guys, we're out of time. So thank you so much for your questions. Kindly reach out to me via email and I can give you detailed answers for your questions. Thanks again. I know it's a Friday and it's a Friday afternoon and you've taken the time to be here. So thank you so much for attending this webinar. Remember, every Friday is a Forex STL Friday. We will put up this. Actually, it's also streaming on YouTube. So you can go to our YouTube channel, that is Sylvia's Traders Lounge. And in case you missed part of this webinar or you'd want to go through the webinar again, it's there on our YouTube channel, that is Sylvia's Traders Lounge. So just go to YouTube, search Sylvia's Traders Lounge. This has been streaming live, so you can get a playback of the webinar. And then if you have any questions, kindly, even for those who posted their questions, please reach out to me via email and I'll answer you. Thank you again. Have a great remainder of your day, great weekend, and happy trading from next week. All right, so let me stop the share.